Hello and welcome to another episode of the Mark Moss Show, where we talk about, of course, the decentralized revolution, which is the way the world is breaking apart. Of course, we look at it through the lens of politics, finance, and technology, so we can bring context to what's going on in the world. If you look at them in isolation, it seems confusing. When you look at them together, it paints a very clear picture. Of course, technology changes the way the world works, changes the way we organize and communicate, and of course, the technology that's driving change is Bitcoin, the decentralized protocol that's changing the world. You know, I like to bring to you some education so you can learn to look at these situations differently. Some latest breaking news and, of course, some interesting guests. You don't have to listen to me talk all the time. And that's what I got for you today. I'm sitting down with a returning guest and a good friend, James Lavish. And we are coming to you from Jackson Hole, Wyoming, where we are here for Bitcoin Ski Week. Pretty fun event. James, thanks for taking the time to sit down with me.
Yeah, of course. Thanks for having me, Mark. Always good to talk to you.
I know I pulled you out of those meetings over there. Anything good going on over there today?
All I could say is there's a lot of signal here. I mean, it's like the exact opposite of the Fed meeting in the spring, right?
Yeah. Yeah. We have what's been imposed is Chatham House Rules, which means sort of like Fight Club. First rule about Fight Club is don't talk about Fight Club. And so we're not supposed to talk about what's going on in there. You know, we kind of have this privacy as a couple hundred people of some of the, movers and shakers in the industry will just say that. And so we kind of have this, we have this kind of privacy thing. So we can't really talk about what's going on. But there is a lot of signal. You know, it's good to see all the things that are being developed and built and kind of see the progress that's going on. But I think, I gave a talk yesterday at TVP, which is Trammell Venture Partners, is a venture capital fund. And they wanted me, they told me what they wanted me to talk about. And they said it was the uncertainty of the global macroeconomic picture. Mm-hmm. And I gave a talk and I said, you know what, you wanted me to talk about the uncertainty, but I'm going to talk about the certainty of the macroeconomic picture.
I see where you're going.
I said, I want to talk about the certainty of that. And so I said, there's no such thing as life as certainties. There's probabilities. Mm-hmm. But this is about as close to probabilistic certainty that we have. And so I gave this kind of talk, which mirrors a talk that you gave in Cabo a few weeks ago. And I started off first because I was talking to this room of venture capitalist investors as well as developers building on that. And I said, what are we all doing here? Are we building a road to nowhere? Like, okay, we're building all this stuff, but like, will it go anywhere? And so let's talk about the certainty of that. And so, like I said, I used a couple of data points that you had given in that talk. I started with talking about how the Fed has been fighting inflation, mm-hmm. and they went from not thinking about raising rates to then it's going to be transitory to, oh crap, we have a problem. Mm-hmm. And now they're committed to crushing demand to bring inflation down. But the problem is they haven't brought inflation down, and instead they've crushed the Treasury.
Yeah.
Is that kind of what's happening?
Fair. That's absolutely fair. I mean, look, the U.S. is not alone. All sovereigns, all fiat backed by sovereigns, they have a debt problem. They have a spending problem. But if we just focus in on the U.S., the issue is that, quite honestly, exactly what you said is this is a certainty, and if the United States government, if the Treasury was a public company trading on the New York Stock Exchange, we would define it as a zombie company. And the reason for that is that they do not generate enough revenues, okay, to pay off the debt that they have on their balance sheet. They don't generate enough revenue annually to pay the interest on their debt. The only way for them to pay that interest off and pay that gap off is to issue more debt, which only makes the problem worse. It's a zombie company. If they would be rated junk status and be struggling to issue that debt.
Now, you said that they don't make enough revenue to cover the interest on the debt. Yeah. They make enough revenue if they didn't pay other expenses.
Right. Well, first, you'll agree with me on this. The U.S. government doesn't really make any revenue. They collect it from the productive citizens of the United States, right? So now they're collecting these revenues through taxes. And it's exactly what you said. And so basically, if you look at it and you break it down, there's three main mandatory expenses that you have for the U.S. Treasury. One of them is your entitlements, which is like Social Security, Medicare, Medicaid, and all that. Well, that adds up to $3.8 trillion, okay, annually. And this just came out in a credit in a.
So that's mandatory expenses.
This is mandatory. They're signed into legislation. This just came out in the Congressional Budget Office, and they put out a report semi-periodically. Just a couple of weeks ago, they put out the report that defines what their projections are. And let me say, these projections are they're pretty optimistic.
Yeah, very optimistic.
As bad as they are, they're super optimistic, which is super troubling.
This is the government's report, the CBO, Congressional Budget Office.
This is the government's own report, right? So, and it's super troubling, right? So, okay, so you got $3.8 trillion of entitlement spending that's written into law for this year.
And that's money they owe to people. That's retirement, pensions, Medicare, Medicaid.
Yeah, and expected unemployment costs, all that, right? And then you've got $800 billion of defense spending. And this is what has been earmarked for defense. This isn't including any extra expenses for Ukraine or anything else that's going on, right? So this is just earmarked for it. But those are long-term contracts. They can't get out of them. They have to pay them, right? So that's the second thing. So now we're at, what, $4.6 trillion. Right. Then you've got what they expect to be this year. Remember, this was just put out, and they expect the net interest to be $700 billion on the debt that the Treasury has issued. So
the government owes $31.5 trillion to the Fed, and they have to pay interest on that $31.5 trillion.
Yeah, and to the Fed and to private citizens and to
whoever owns treasuries.
Companies. Exactly. So now add that all up, and we're at $5.3 trillion of expenses. What does the U.S. Treasury expect to take in tax revenues this year? $4.8 trillion. So you don't have to be a math genius, and as our good friend Greg Foss likes to say, it's not even grade 11 math. This is like grade 4 math, right? In elementary school. These are mandatory expenses. So then when you add in all the other expenses on top of it, so you're at a $500 billion hole. But when you add in all the other expenses, Mark, you're at $1.4 trillion. That's expected this year. We're expected to have a deficit of $1.4 trillion. Then,
and that's based off of their expectations of how much money they expect, or I should say, hope and pray to receive.
Exactly. And so,
and that's also based off of the interest being what it is and not going up higher.
That's right. That's right. And so, but when you add in certain adjustments and programs and then you add in the major problem is what you defined before, is that the Fed is putting the Treasury in a very difficult position. Why is that? Well, the Treasury issues their debt, okay, and we have about $31.5 trillion outstanding, and to keep it simple, about 50% of that debt is being retired in the next 1 to 3 years. Okay, so what does that mean? Well, that debt matures. Well, how do they? When that matures, then
because for everyone listening, what that means is that the debt isn't just all owed next year or in 30 years. It's 6 months, 2 years, 5 years, 10 years, 30 years, et cetera.
Right.
Different maturities.
And as it matures, they have to give the debt owner, the one who bought the debt, they have to give them the principal back. Well, the Treasury doesn't have that money, so what do they do to give them the principal back? They issue more debt. So essentially, they're replacing that old debt with new debt. The problem is the interest rates on the new debt are about 3 to 4% higher than the old debt. So it is creating this massive hole in the balance sheet of the Treasury, because now they are owing way more interest than they owed just last year because of the higher interest cost on the new debt. So it just becomes a self-fulfilling spiral. It's called the debt spiral, and this is what we're...
James, so we are going through basically how the Treasury has to pay interest on the debt, but some of the interest is some of the debt needs to be rolled over or turned over in the next year, and some has to be in 30 years. But the problem is, when does it have to be refinanced, and at what rate, and what will that do to the amount that's owed?
Exactly. So the current yield on the average yield on all the treasuries that are outstanding right now is 1.7%. As you retire that debt, which was issued, most of it was issued earlier, which means it's lower rate. Okay, so it's under that average. Well, if 50% of that matures in the next 3 years, you have to replace that with new debt, and now you're talking about replacing it somewhere between 3.5% and 5%. Problem.
Let me ask you a question about that. First of all, 50% in the next 3 years sounds really bad. What's even worse is it's 30% in 1 year.
Yeah.
Now, when you say it has to get it'll get a new rate of between 3.5% to 5%, will it be at the rate of what the Fed funds rate is? So right now it's going to be 5%. Where do you get the 3.5 to 5?
Yeah, exactly. So the short term, anywhere from 3 months, 6 months, 1 year, 2 years would be much higher rates. And then as you go further out, you go to the 5 year, 10 year.
Got it.
Okay, they're at lower rates.
Got
so,
it. Okay.
but and here's the problem. To simplify it for everyone, it's like a single parent who has their mandatory expenses. You've got your mortgage, you got your car payment, you've got food you've got to put on the table for the kids. You've got to pay your energy bill. You want to keep the heat on. These are things that you have to pay, right? So if you're working 2 jobs, you don't have any more time to work, and you're just not meeting the margin, what do? Well, you take out a credit card. And it's an obvious thing, so you take out the credit card and you start charging food and some gas and other expenses on your credit card.
And let's say hypothetically you get like this introductory low interest rate.
Right. And then the low interest rate goes away, and suddenly it spikes up from 0% or 5% up to you're 17, 18, 22, 28%.
Right.
Okay. So, and then eventually your interest payments on that credit card are so big that now you've maxed out that credit card, and what do you have to do? You take out another credit card, and it happens, and then you take out another credit card. The problem is, as you take out more and more credit cards, your credit score goes down. The interest rate on all those credit cards goes up. The problem becomes worse, and that's the debt spiral. That's simply what we're doing in the United States. Now, I'm not saying that the United States is going to go, it's going to go bankrupt, and I mean it is bankrupt, but it's not going to disappear.
The
Treasury,
default.
It's
Stop
not going to
paying
default.
it.
Yeah, it's not going to default. It wouldn't default because we can print our own money and we can buy our own bonds,
And that's the inevitability.
And that's the inevitability. So that's the point, right? So
I saw President Biden or whoever writes his tweets, I think it was yesterday, said the U.S. has never defaulted on its debt. Let me be clear. We're not going to default. We're going to get this debt ceiling raised or whatever. Something to that effect. I don't remember exactly. And I was going to reply to it. Actually, I might still have it saved in my drafts. But I was like, someone should probably tell him.
Maybe someone should tell him that we have defaulted.
Yeah, that's what I was going to say. Like, hey, someone should probably tell him, like, we've already actually defaulted. Like, if you have to take on more debt to pay old debt, like, I thought that was like a Ponzi or something.
You kind of like that.
Yeah.
So, it's pretty simple. You operate in a deficit. You issue debt to cover that deficit at higher interest rates, causing larger deficits, leading to more debt, leading to higher interest payments, leading to larger deficits, and then more debt. It's just a spiral you can't get out of, and that's where we are.
So to frame this up, the inflation got out of control, so the Fed decided to jack the rates higher and faster than time in history. They've done that, and they haven't really had much of an effect on inflation.
Nope.
But with the interest rates going up so high, they have caused the Treasury to pay more interest on the debt, which they can't afford to do. On top of that, and I don't think you talked about this yet, or maybe, but on top of that, by what they're trying to do is crush demand. What they've done is trying to crush demand and make people poor, and they've done a pretty good job with that. And when people are poor, then they don't spend as much, which means there's not as much tax income coming into the Treasury.
Right, and that's exactly right. So as we're seeing some indicators, and they're kind of mixed, but if you tighten credit enough, you will run into an issue where you're going to go into a recession. That means that your productivity contracts, which means that the revenues generated for the companies contract, and the multiples on those securities that trade in the stock market contract. Everything just feeds on itself, and so it just equals less tax revenue for the government. Okay, so again, like, what are their choices? What can they do? They're trying to get inflation down because they can't let it get out of control. Because if inflation's out of control, then what sane investor is going to buy a bond that's based in a currency that's deflating, inflating, meaning it's debasing in perpetuity, and at a rate that it just doesn't make sense. It's called a negative interest rate, a negative real rate. So, but what are their choices? Like, what are the government's choices, right? So, you can either have austerity,
which means live on a budget, live within your means,
right? So you can cut programs, you can cut spending, you can cut government spending. That's political suicide. Neither party is going to do that. Both parties are going to try to get the other one to do it. It's a trick,
No one's ever going to be elected running on a campaign to take money away from people.
Correct. And or you could raise taxes.
Yep.
Also not, politically.
There's only so high you
favorable.
can go.
Exactly.
And if 50%'s about it, and then the people revolt.
People revolt, and it actually ultimately worsens it lowers GDP. It impacts your productivity negatively, and so you get the same result. Yeah. You're going to have lower tax revenue, or there's a third option is issue more debt, which is the obvious one, which is what we've been doing.
Debasement.
But that's the fourth option.
Oh,
right. So the fourth option is
one is the default.
Right. Or you're not going to default.
Right. You're not going to default.
You're going to issue more debt. Okay.
Right.
So, and then one derivative from that is your point is debasement, which is allow inflation to run hotter than they admit to. Imagine that. CPI, we've seen how the CPI has been, you've done videos about this, how the CPI is manipulated, how they're kind of lying about how much,
Well, they just changed the way they calculate it.
They're kind of hiding how much. But the point is that it allows them to generate a GDP, generate revenue that the government can collect taxes on. That's at a higher. It's just more dollars, right? Because it's inflated, and then they pay down old debt. That debt that they're paying down, they're paying down old debt with cheaper dollars.
Yeah. So
it's called debasement. And it's called inflating away the debt. And they're going to do this for as long as they possibly can. And that's the point that why this all matters is that money is being taken out of people's pockets every day in order to keep this Ponzi going, period.
Yeah, why does it matter? That's like always a question I try and come back to. And to me, why it matters is trying to get the direction right. Because I think if we zoom out, we'll figure that out. As we break this down, just kind of think about we're trying to think about the direction things are going. So this doesn't tell us what's going to happen next week or next month, but I feel pretty good about what is going to happen over the next 5 years, right? And so the longer you zoom out, I think the clearer the picture gets. And so we want to be right directionally. So just kind of think about that. And I think it's also one reason why you see, even though Jerome Powell keeps going, hey, markets, you don't understand. Pain. We're going to crush you. We're going to come down. But the markets are like, yeah, right. We know where that limit is. And so every time inflation comes in hotter than they expected it to, it's more sticky than they wanted. The unemployment rate is staying low. Wages are staying high. All these things. All the people on TV are like, well, higher. They got to hike higher for longer. Higher. It's like this parrot, right? Higher. But how high and how long can it really go?
That's right. I mean, if they can, there's a lot of calls that have been going around over the last number of months, and you hear Chairman Powell talk about he's kind of invoking the Volcker era, and he's going to be Volcker. Like he's kind of wants to embody that. Wants to be seen as the hawk that tamed inflation, and the reality is. That was at a time where debt to GDP was a fraction of what it is now, right? So what does that mean? That means that our debt was 30% of our GDP. Now it's 130%. So he literally cannot do that without destroying the treasury. We would have to debase so rapidly. We would have to print so much. He can't do that because of exactly what we just said. If you raise rates to 10% or 12% or 15%, there's no way you could get to 20%. It's just not. It's mathematically. It's mathematical suicide for the currency. We would destroy the currency. So, again, what's their choice? Just to keep inflation running a little bit hotter than they may want to admit to.
Maybe a lot hotter.
and inflate away that debt. That's what it is. But look, Mark, we've raised the debt limit 22 times since 1997. And we're going to do it again. We're going to do it again and again and again. That's an absolute certainty. We're going to keep doing it. The Treasury put out a chart. It's crazy. This is the craziest thing. They actually put out a report recently, and the report was titled. It was titled "An Unsustainable Fiscal Path."
Yeah,
the U.S. Treasury put this out, and they put out this chart of what they think the percentage of debt held by the public is going to be, right? And it looks like a hockey stick as a percentage of GDP. It looks like an absolute hockey stick. So like when you get out to years 2050, 2060, it's like we're nearing 1,000%.
Meaning they're expecting the debt
to just keep growing. And it goes straight up. It's actually, it's unnerving to see that they, first of all, they admitted it. They see it. They know it. But this proves that they know there's just no way out. There's just no way out. And so eventually the U.S. will likely be the last currency to fail. But there's just no way for them to get out of this problem.
Yeah. So, and a couple other things. So, there's no way to get out of the problem. The only way they can keep servicing the debt is to take on more debt. Biden tweets as much. He says it in his tweets. They put the reports out and they tell us that. So, like, this is not James and I sitting here thinking speculation. This is what they're saying, and this is math, right? And then you throw in things like, well, printing more money causes inflation. So there's going to be more inflation, and they're having to print at the same time, which is a problem. But then if we even look globally, and the one thing I want to jump from is that, and I think you had talked about this is not just a United States problem. This is a global problem.
Yeah.
Right. All the governments of the world and central banks of the world are in the same basic predicament.
Yeah. I mean, you can see the cracks appearing all over the place. Like Japan's an interesting one because they've been running a high debt to GDP for a very long time. They have a different demographic. They're a net exporter. We're a net importer. So it is a different beast. However, what they've been doing recently is they've been trying to get inflation hotter. Well, why are they doing that? They keep saying we need inflation, we need inflation, we need inflation. Well, because their debt to GDP is 250% already. Right? Remember, U.S. is only running about 130%. Theirs is 250 already.
Only 130. Really, the kill zone. If you're climbing Mount Everest, I think they call it the kill zone. If you could go above it, and the kill zone is like 90%. So we're way above the kill zone.
Yeah, way above. So, but in Japan, they've gotten to the point where they're holding their 10-year Treasury at a 50 basis point yield, which means that they're standing there and buying as many Treasuries as anybody sells to be sure that interest rate doesn't go over 50 basis points. So they're monetizing their own debt. What are they doing? They're printing yen and buying bonds. And now the Bank of Japan is the largest owner of all issued JGBs, Japanese government bonds, in the world.
Yeah. So if we look at it like the globe's having the same problem. And then if you look at this, then we have wars going everywhere. So now the U.S. is trying to get into war with China and Russia and Ukraine. And war is very inflationary. Supply chains break down even more. And I would say that most of our inflation that we had is not demand side, which is why the Fed's losing. It's supply side. And so war is going to create more problems in supply side. It's also going to create more demand as well, right? So now we saw... the U.S. doesn't have enough munitions for 1 week in the Taiwan Strait, and so we're running out of munitions to send to Ukraine. So we have to resupply. And I think what we're seeing is Zoltan Pozsar had this theory of going back to this commodity-based money, and so where people don't want to hold dollars, they would rather hold the commodities in the ground. I saw this week Russia said they're going to reduce their oil production because they'd rather keep the oil in the ground.
It makes sense.
And that pushes the price of oil up, which is more inflation.
Yeah, energy, all productivity relies on energy, right? Just put all the pieces together. Debt in itself is not inherently bad. You can pull future productivity into the now, but when you issue too much debt and you get over your ski tips, as we say, in the investment world, then
I'm a dirt biker. We say over the handlebars.
Okay, yeah. You get over your there you go. I like that even better. You get over your handlebars, but that's the problem. So therein lies the issue, right? So exactly what you're saying.
Ludwig von Mises, arguably the godfather of the Austrian School of Economics, he calls it the Crackup Boom, and he says, and then suddenly everybody realizes inflation is both intentional and permanent. And then nobody wants it. And so they're quickly trying to exchange it for goods and services as fast as they can. And that leads to this hyperinflationary boom. And so I think we're seeing that, back to Russia, they'd rather keep the oil in the ground. Central banks bought the most gold on record last year. So over the last couple of years, they've been buying more than since 1971. No, now they bought the most on record. General Motors invested $650 million in a U.S. lithium mine. They'd rather have the lithium in the ground than the money. Volvo did, LG did. And so this is like a really, really, really strong trend that's happening. Now, I want to kind of talk about what do we do about all this? What do we do about all this? So the first thing is if we look at a couple of examples, I used this chart in my presentation yesterday. If you look at the Zimbabwe stock market from 2012 to 2020, it kind of meandered down a little bit, and then it shot up like a skyrocket. We know if the Turkish lira has lost 90% of its value to the U.S. dollar over the last 5 years. So if we were in Turkey 5 years ago, if we had a time machine, what would we have done?
Yeah, you buy your Turkish stocks.
We would have not wanted to hold Turkish lira.
Right.
We would have wanted to get into something else.
Exactly.
And then maybe we'd want to take debt in Turkish lira.
Exactly. Yeah.
So then you would go, and so we see the Turkish lira over the last 5 years lost 90% of its value. So we would have not wanted to hold Turkish lira. We'd rather hold like U.S. dollars. And so we don't, now today we can see the U.S. dollar has lost 65% to the S&P 500. It's lost 45% to the median real estate. So the dollar is also doing the same thing. So probably just what central banks are doing, just what GM, Volvo, and LG just did, what Russia's deciding to do, we probably don't want to hold fiat, and we'd rather hold commodities.
Well, one of the biggest mistakes people make in these countries is they can't get out of their fiat, right? So what do? They go into the stock market. So you play that, they'll buy that stock. You'll see the stock market kind of melt up. Why? Because it's the easiest thing for them. They can buy fractions of things. They don't have to buy real estate. They can just buy a little bit of stock. And so you see the stock market run. But what happens when they need their money out? They sell that and they get what?
Back to Turkish lira or whatever.
Back to lira or back to, yeah, exactly. So, and therein lies the issue. But if you get your money out of lira.
Yeah. So, these companies, GM bought a lithium mine. I can't buy a lithium mine. The problem with commodities is that commodities are very hard to own. I mean, you can own some gold. If you have too much gold, you can't. You have to have someone store it for you. Obviously, I can't take delivery of a barrel of oil. I can't have uranium in my house, right? And so commodities are very hard to own. The best commodity in the world, and best is a relative term, but I like Bitcoin, right? Bitcoin is a commodity, and Gary Gensler, the head of the SEC, has been coming out and repeating over and over and over with increasing frequency that Bitcoin is a commodity and nothing else. And I saw Bloomberg Intelligence put out a piece last year, and they said that Bitcoin, they expected Bitcoin to move into a risk-off asset. And I think we're starting to see that in some regards. And so I think about Bitcoin as a commodity, one that's going to be in massive demand if this thesis is true, which let's actually not say the thesis. If what the government and the Treasury and the CBO is telling us is true, which I believe, then they're going to print lots of money. And so then we want to not hold that. We want to hold commodities. Bitcoin might be the best commodity, and we can take custody of it and all those things. And potentially we're starting to move into this risk-off asset, which looks like it could be happening.
So yeah, let's talk about that. So first of all, going back to your main point, which is you want to own assets, right? So using some of Lynn Alden's recent research, if you wanted to buy 1 barrel of oil back in 1913, it would have cost you just under $1, right? So today, 1 barrel of oil will cost you about $80.
Wow.
So if you had held a barrel of oil all those years, right,
you would still have a barrel of oil.
Exactly. So, or if you had an ounce of gold, it would have bought you about 22 barrels in 1913 of oil, and today 1 ounce of gold would buy you about 24. So it kept your value. But there are so many problems with gold, like you said. I have nothing against gold, but it's not the ultimate store of value, and it's not easily transferable. You can't transport it very easily. You can't cross borders with it very easily. But in exact opposition to that, Bitcoin, it's decentralized, it's immutable, it's scarce, it's easily transferable, and possibly most important of all, it's censorship resistant.
Possibly. I would say it probably is. Now, I've been a commodities investor, mostly precious metals and energy for a long time. But again, I can't really take a barrel of oil delivery. And so, I'm not the super advanced options trader. So I'm not playing a lot of oil futures, things like that. But I like to invest through the oil ecosystem. So I like to buy pipelines and tankers. I like to buy drilling. Manufacturers are creating new drilling technologies, things like that, and through the ecosystem. Same with other commodities and things like that. It seems like the way the Bitcoin is kind of setting up, we're starting to see this ecosystem full of opportunities as well.
Yeah, it's massive, and you've talked about this before, and you hit on this really hard in Cabo, and it's about Bitcoin being the sixth technological revolution. You know, and we've had our hydropower, we had our steam power, you had electric power, you had combustion, which the cars and automobiles and airplanes, and then you had communicating and storing information. You had the microchips. You had Intel, Microsoft software,
the FANGs, Facebook,
FANGs,
Apple,
exactly,
Netflix,
and
Google,
and the internet, and the internet. And now with Bitcoin, you have something that communicates and stores value, and that's the revolution that will create all of and will disrupt. It will disrupt and create new areas and industries and sectors. And so, like you're saying, you invest not just in oil and not just in Bitcoin, but you invest in oil drillers, oil services, tankers, anything that's around that business, and you diversify your investment, and you can do the exact same thing in Bitcoin.
Yeah. There's so many opportunities that are popping up. So I know, something I've been working with you on, and a couple other people. You mentioned Greg Foss earlier, Greg Foss and Laura Lepard and Corey Clipston, David Foley. We're working on kind of trying to take advantage of opportunities that have been created based off of where we're at in the market cycle, things like that. You want to talk about ways that maybe there's ways to get opportunities in the Bitcoin space that you're kind of thinking about or focusing on?
Yeah, I mean, this last year, Mark, we've seen a tremendous amount, as you and I have talked about quite a bit. We've seen a tremendous amount of damage done to the cryptocurrency world
because of market cycles.
But there was some nefarious activity.
Yeah,
there was bad or no risk management. And that's bled into the Bitcoin ecosystem just purely through contagion, right? So whether it's in finance or payment solutions or social apps or wallets or node software, whatever it may, Lightning Network, whatever it may be, there are these startup companies that are starting to build out all of these disruptive technologies off of that Bitcoin-based layer that have gotten themselves into financial trouble, and they're called distressed companies. And some of these are great companies. They just again got over their handlebars, and now they're in need of cash. They're trying to raise their next round of capital, whether it's a Series B or whatever it may be, or there's some distressed miners that are publicly traded, some are privately traded. There's just a lot of opportunity in the space, and there are ways that we can, and that's why we started this whole fund. We literally started this Bitcoin Opportunity Fund in order to not just take advantage of these opportunities, but to help these companies that we believe in that need capital and will be vital going forward. And it's just, you're in that cycle right now, and the timing is right. So,
yeah, The saying is, and you've all heard it, I mean, there's variations of it: buy when there's blood in the street, and buy when people are, sell when people are greedy, buy when people are fearful. The problem is when you see that there's a Black Friday sale, you're willing to wait in line all night to go get that discount, right? People get trampled. Literally, people get trampled and die trying to get a discount. But yet when
on a TV,
right? But when financial assets go on sale, people tend to be afraid. So think about that. If you're interested in learning more about the Bitcoin Opportunity Fund, check out bitcoinopportunity.fund. You can check that out. You can request more information if you want to check it out. But either way, think about what Bitcoin is going to do in this type of environment of what I would call almost certainty, when the government, the Fed, the CBO, the Treasury tells us what is coming next, and that is lots of money printing and debasement. And you better figure out what type of lifeboat you want to be in when this inflation tide comes to wipe everybody out. I know which boat I'm in. I'm in the Bitcoin boat. I'm in the Bitcoin ecosystem boat. So check that out. Check out at James Lavish. Follow him. Check out his information, his newsletter. Of course, I am at OneMarkMoss. If you missed any of this, you better go listen to the whole thing. You can check it out on the podcast. Just search The Mark Moss Show on any of your favorite podcast players. You can check it out on YouTube, also at the Market Disruptors channel. And that's what we got. Thanks so much for listening today. Get on that lifeboat. Until next time.
Thanks for having me, Mark.